It is a fact that central banks lease gold. All of the American gold, except this tiny little sliver that's it's not even 1% of the gold that's still held by the Treasury. All of it has been rehypothecated. It's been the title has been given to the Federal Reserve, our central bank. The Federal Reserve owes it back, but then they have rehypothecated it, and it's been rehypothecated and rehypothecated, and so it keeps on getting lent out on contract after contract. But normally, they would go and lease gold from a central bank and deliver the gold that is contracted for and then pay it back later, and they pay a couple percent interest. And so the central bank gets to make 2% interest on that gold. Well, if they are right now trying to unwind all of those gold leases that they've done, that would cause the gold price to rise.
Gold and silver are once again dominating the global financial landscape, defying skeptics who underestimate hard money. Both metals have held up this quarter despite tighter liquidity and macro uncertainty. Gold has been rising above important resistance levels, reflecting growing skepticism in fiat regimes. Silver, long, the more volatile but reactive metal, has gained over 20% since late July and outperformed major commodities indexes. Retail euphoria and speculative positioning are no longer driving these swings. Structural reallocation toward tangible stores of value is. Mike Maloney recently highlighted a startling finding that shows how price suppression has warped gold's value over the decades. By comparing London trading hours to global trading sessions, he found that gold's price could already be at 5 figures if it matched non-London market characteristics. This perspective shows a decades-long gap between paper market pricing and physical demand. Ironically, the low gold price has produced one of the greatest financial asymmetry opportunities, an opportunity that may be closing as central banks and institutions shift to metals. This rising interest in precious metals correlates with fiat debasement. The Fed may have delayed rate hikes, but U.S. debt is rising. Trillion-dollar deficits, mounting interest payments, and a weak bond market support gold and silver long-term. Major currencies' real buying power declines. Recent dollar index resilience hides the dollar. It acquires less hard assets each quarter. Although lessened in official figures, inflationary pressures persist in global supply chains and energy markets. Investors are repositioning, not speculating. Gold and silver narratives have grown as institutional sentiment shifts. The top banks and asset managers now consider them part of diverse portfolios. J.P. Morgan accepting gold as collateral and Morgan Stanley suggesting fundamental modifications to the 60/40 allocation are confirming what contrarian investors already knew. Tangible assets are reclaiming their significance in wealth preservation methods as paper promises lose trust. Maloney links the bond market's instability to a worldwide rush into metals and examines how supply restrictions in major mining operations could boost silver's upside. He also discusses how decades of gold leasing and rehypothecation are finally coming down, triggering a major revaluation. We'll let him explain before introducing Peter Schiff's compelling analysis of gold and silver's new bull cycle. Please subscribe, like, and comment before we begin. Stay tuned to the finish. Appreciate the support and enjoy the video.
Of the New Orleans Investment Conference, which I'm going to get to in a minute, for this thing. He says probably nothing. Peak administration mentions of the Fort Knox audit, and then radio silence as gold goes through the roof. Well, they are it is a fact that central banks lease gold. All of the American gold, except this tiny little sliver that's it's not even 1%. Of the gold that's still held by the Treasury. All of it has been rehypothecated. It's been the title has been given to the Federal Reserve, our central bank. The Federal Reserve owes it back, but then they have rehypothecated it, and it's been rehypothecated and rehypothecated, and so it keeps on getting lent out on contract after contract. But normally, they would go and lease gold from a central bank and deliver the gold that is contracted for and then pay it back later. And they pay a couple percent interest. And so the central bank gets to make 2% interest on that gold. Well, if they are in right now trying to unwind all of those gold leases that they've done, that would cause the gold price to rise, and it would be a good reason for this radio silence, basically. And so I mentioned Brian London running the New Orleans Investment Conference, which has had speakers like Milton Friedman and Ayn Rand. Oh my God. So I'm going to be there, and it's the November 2nd through the 5th, and use neworleansconference.com/Maloney, and you'll get counted among the people that registered because of me, and I will try to make time for us to get together there at the conference. So please make sure you use that link to register. Anyway, moving on, the LBMA hides gold and silver fix, stops providing current and historical prices to Kitco. Literally nothing to see here, folks. Move along. This is from Nick Laird at Gold Charts R Us. I've been instructed by the ICE that I am not allowed to display the LBMA gold and silver fixes upon my website as I don't have a license. Here is the ICE. It's the Intercontinental Exchange. That's where the LBMA prices come from. Why would they hide these? Well, if you are being caught committing a crime, if you're being charged with a crime, the very first thing you do is you gather up all the files and you head to the paper shredder and you shred them all and get rid of the evidence. Well, that's what they're trying to do, is get rid of the evidence so that people like Nick Laird can't do this great investigative reporting. This is just math. The red line is the price of gold. The black line is the price of gold if only the London hours were traded. In other words, from the AM fix throughout that trading day to the PM fix, if that was the only trading that goes on, and then you paste that to the previous night's close of the London trading only, what you end up with is gold went from 1971, it was at $35, and today it would be $2.24. If you only take the trading at the close of London when the rest of the world is trading, and you take those hours, the percentage change in price during those hours, and you paste it to the previous day's close of the percentage change of non-London trading hours. Everybody else in the rest of the world, you come up with $50,000 gold. Now, this is just little by little, day by day, bit by bit, but this criminal price suppression actually is the great opportunity that has been provided to the precious metals investor. They are losing control. And as they do, the price will explode. This is the metaphor of pushing down on a spring, and when you lose control, it's going to bounce a lot higher. And so this criminality from them is your great opportunity. Luke Groman, I want to thank Luke for this wonderful chart. The red line. Hi, it's Mike here. Just a quick message. I wanted to welcome the huge number of new visitors to our videos, but point out that less than 15% of our viewers have subscribed to this channel and hit the notification bell. We're heading into some turbulent times, so if you don't want to miss any updates, make sure you enable notifications. And thank you as always for clicking the thumbs up button. One more thing. At GoldSilver.com, we've been providing top-notch educational content for over 20 years. If you'd like to help us continue this mission, we'd be honored to be your precious metals dealer. And now, back to the video. Thank Luke for this wonderful chart. The red line is the S&P 500. The blue line is the S&P 500 priced in gold, and the S&P 500 has lost 21% since August 15th, 1971. It's down 21% priced in gold. And, gold was $35 an ounce then. Sovneteg, I'm not sure how to, but 1 year ago today, this was September 19th, the Federal Trade Commission posted this warning saying anyone who tells you to withdraw money, that's currency, not money, and buy gold bars, which is money, to protect is a scammer. And here it is from the FTC, Federal Trade Commission. Did someone tell you to buy gold bars to protect your money? No, it's to convert your currency into money, and that protects your purchasing power. It's a scam. Well, let's see how well the FTC has protected everybody. Oh, let me see. Gold is more than $1,000 higher. We're in the 26s. It's $1,100 that they protected you from making on profit, which is a 45% return over that same time period. So, Geiger Capital. Gold stopped tracking U.S. real rates in 2022. And this is the 10-year Treasury inflation-protected security, the TIPS. So inflation-protected U.S. Treasuries. And it's a little bit different than the 10-year minus inflation, the real rates. But look at the correlation here.
Mike Maloney's institutional sentiment breakdown changed precious metals. The Bond King officially advocates a 25% gold allocation, and major banks openly recommend long gold and silver positions, signaling top-level finance capital rotation. Bonds were thought to manage equities volatility. Therefore, the 60/40 portfolio was sacrosanct for decades. That connection is failing. Gold is being reintroduced as a need when yields rise and sovereign debt loads rise. A fraction of institutional capital from bonds to metals might boost demand to levels not seen in modern markets. The supply-side restrictions mentioned by Maloney support this forecast. Freeport-McMoran's force majeure on its grass mine operations shows how unstable essential metal supply chains are. Tightening supplies and rising institutional demand create significant repricing. Maloney suggests that official channels like Fort Knox audit updates are silent because the system is sensitive to gold's real value. A silent accumulating pattern. Global leasing winds down and latent demand could suddenly affect market prices. Peter Schiff feels an awakening is underway.
So on the week, the GDX was up 3.2% and the GDXJ up 3.7%, but not nearly as much as you would have thought given the big moves in gold and silver. And I think a lot of that had to do with the shakeout from Thursday. And I think some people were a little shy today to even buy these stocks, which I think is setting them up for another big rally. In fact, I think that we can move above 4,000 in gold next week because it's only like $110 away. I mean, that's nothing. And silver is less than $2 away from 50. And this may be the last weekend that you can buy silver below 50. We'll see. I mean, I've been telling everybody on the Friday market wrap not to wait till Monday. Buy over the weekend. And if you would have followed my advice last week, and if you bought on Friday night, if you bought any time on Saturday, if you bought any time on Sunday morning, Sunday afternoon, you got basically unchanged. But if you waited till Sunday night or Monday morning, gold was up $70, I think, on the Monday. Silver was up all over $1. We had a big move. Most of the move happened. But then, we continue to build on that. But I think the same thing is probably going to happen again. I mean, there's no guarantee. But I think a lot of buyers come out on Sunday. A lot of foreign buying. Maybe the central banks, they start the week and they buy some gold. So I would expect another big move. And I would just buy. Again, hopefully you bought last weekend or the weekend before, right? As I've been telling you. Sales have been picking up at SchiffGold. They're about double what they had been, but, they're still not anywhere near where they should be given what's happening. Now, I think one of the reasons that we had a muted reaction, I think, in the mining stocks this week was we finally had a big rally in cryptocurrencies. Bitcoin was up about 12%. We almost hit a new high in Bitcoin. In fact, the Bitcoin ETFs, the exchange-traded ETFs, hit new highs. But Bitcoin itself didn't because when it hit its high of just below 125,000, those exchanges were not trading. But we came close, not quite there, but maybe we'll get up there. As I'm recording this, Bitcoin is 122,600. So it's pulled off a bit from its intraday high. But I think maybe some people sold some mining stocks and maybe, went into Bitcoin stocks. I think that's going to be a mistake. In fact, I think the fact that you have so much profit taking in gold stocks this week, despite the record highs, right? Record high price of gold, 14-year high in silver. And rather than rushing in and buying stocks, you had a lot of people cashing out and saying, well, let me take my chips off the table, let me sell. That is very healthy for a bull market, to have profit taking, to not see a lot of speculators rushing in to buy the highs, but people are being cautious. They're paring back their positions. They're not rushing in to buy. All that is a sign that these are early days in this bull market. We still have a long way to go. But, the sell-off that we had all basically took place on one day. And even though silver was way down, it recovered. It was still negative on the day. And some of the gold stocks that were down 3 or 4 or 5% ended up positive on Thursday. Now, most of them finished negative, but way, way off the lows. So the money to buy the dip came rushing in. I mean, it used to be when gold went down, it could go down for weeks. And when gold stocks went down, they didn't just go down, they got killed. But there's now so much money that wants to come into this market that the dips are shallow and they're over very quickly, which is why I've been telling all the SchiffGold customers, don't even bother waiting. I mean, yeah, if you waited for a dip, you could have got lucky and got one on Yom Kippur, but it didn't last long. It was a short sale, and it still didn't even get back down to where you could have bought it the week before. It just crashed down to 46, right? The low 46s, and now we're back above 48. But, there should be some resistance at 50, I would imagine, because we have this huge double top at 50. But who knows? I mean, I wouldn't be surprised if we blow through 50. But I do think that once silver gets above 50 and holds above 50, Katie, bar the door. It's going to be a big rally. And gold's going to rally too, right? It's not like gold's not going to rally when silver's rallying. It's going to rally. I just think silver's probably going to rally more. That's why I've been, really trying to push people to get some silver, especially if they haven't had any, because I still think it's very cheap in relation to gold, which is also cheap in relation to all the dollars that we've printed. But not just all the dollars that we've printed.
Peter Schiff's study confirms Maloney's claims in the near future. Gold closed the week at $3,900, while silver broke 48, a 14-year high, challenging technical and psychological boundaries that have held precious metals back. Schiff notes that intraday volatility and forced liquidations in thin markets have strengthened the bull thesis by shaking away leveraged traders and strengthening long-term positions. His remark that profit-taking is occurring at record highs is telling. It suggests a solid bull market, not a speculative bubble. Schiff's emphasis on market behavior during drops is notable. In prior cycles, gold or silver pullbacks caused cascade sell-offs. Every pullback now generates rapid buying pressure. Due to actual investors, individuals, funds, and even central banks planning for the next leg upward, liquidity is growing beneath the surface. Schiff's projection that gold might break $4,000 and silver could break $50 matches the global context of deteriorating fiat and debt confidence. The analysts are coming together from different angles. Real money is being restructured. Capital seeks protection when the world's largest bond market loses credibility. In this new era, safety is scarcity, not surrender. Gold and silver symbolize scarcity. Over $35 trillion in global government debt will mature in 24 months, and trillions more in derivatives exposure tied to unpredictable interest rate assumptions will increase demand for unencumbered collateral. That need is almost exclusively supplied by precious metals. Geopolitical interruptions are not the only supply restrictions. The mining exploration pipeline is critically thin due to years of underinvestment. Less than 30% of worldwide silver output comes from primary mines, while the rest comes from base metal production that slows during recessions. Silver supplies may tighten as the global economy slows and industrial and investment demand peaks. Additionally, the central bank bought 1,100 tons of gold in 2023 and 2024, a record. The trajectory turns bullish. Gold and silver are increasing and being repriced to reflect decades of suppressed fundamentals and monetary excess. Whether this repricing is gradual or aggressive depends on how quickly debt system credibility erodes. Maloney and Schiff note that early investors gain greatly from this shift. These markets are no longer side bets. In a fiscal reckoning period, they constitute the foundation of smart portfolio construction. If you like this research, like, subscribe, and share it with other investors following global market realignment. Thanks for watching and keep tuned. We'll follow Mike Maloney, Peter Schiff, and other leaders as this historic precious metals bull market unfold. Thanks for watching.